Okay, so you want to own a mansion. Buy the biggest house on the best street, move in, and finally live the way the money was supposed to let you live. 20,000 square feet, a gate with a code, a driveway long enough that you can't see the road from the front door, a kitchen that could feed 40 people, a pool that glows blue at night, a wine room, a gym, a theater, a lawn that somebody else cuts. You walk through the front hall on a Tuesday morning with a cup of coffee, and the house is completely silent, and the silence is the whole point. That's the picture. That's what the listing photos are selling, and they're very good at selling it. The problem is what happens between the dream and the reality. Not because the dream is fake. The house is real, the pool is real, the silence is real. The problem is that everything you just pictured is the output of a machine, and nobody in that photo shoot shows you the machine. Somebody has to run it, staff it, insure it, heat it, repair it, and eventually sell it. And the numbers on all 5 of those things behave in ways that almost nobody expects going in. Let's start with what you think you're buying. You think you're buying an object with a price. The price is $12 million. You've saved, you've sold something, you've had a liquidity event, and 12 million is a number you can survive. So you sign, you close, you get the keys, and in your head, the expensive part is over. The expensive part has not started. A house at this level costs somewhere between 3 and 5% of its value every single year just to exist. Before you improve anything, before you change anything, before you enjoy anything. Call it 4% on 12 million. That's $480,000 a year to own a house you already paid for. $40,000 a month, every month, whether you're in the country or not, whether you love it or not, whether the market is up or down. That number does not care about your calendar. And here's the first thing that surprises people. That annual burn is not driven by the price you paid. It's driven by square footage, by acreage, by the number of systems in the building, and by the replacement cost of the structure. Those are physical facts, and they don't fall when the market falls. If the value of your house drops from 12 million to 9 million in a soft year, your operating cost does not drop with it. The roof still has the same number of square feet. The staff still shows up. The tax bill mostly doesn't move. You've lost $3 million of net worth and saved nothing. That's the shape of this entire asset, and it's worth holding on to. The value is variable. The cost is fixed. Now, financing. A $12 million house does not get a normal mortgage. It's above every conforming limit, which means it's a jumbo loan, which means no agency is buying it, and the bank has to keep it on its own balance sheet. When a bank keeps a loan, the bank gets picky. Expect 30 to 40% down. Expect a full accounting of your liquidity after closing, because the underwriter wants to see that you still have real money left in the months after you've handed over $4 million. Expect the bank to want a relationship, deposits, investments, the rest of your financial life, because the mortgage is often the loss leader and the assets under management are the actual product. So you put down $4.5 million and finance $7.5. At a rate in the 6s, that's roughly $45,000 a month in principal and interest, or about $540,000 a year. Stack that on the top of the $480,000 of operating burn, and the house costs you a bit over $1 million a year in after-tax money before you buy a single piece of furniture. The obvious response is to pay cash and delete the mortgage. Plenty of buyers at this level do exactly that, but paying cash doesn't remove the cost. It just moves it somewhere you can't see. $12 million sitting in treasuries at 4.5% produces $540,000 a year. The moment you convert that portfolio into a house, that income stops. The mortgage payment disappears from your statement and reappears as an income you no longer receive. The house is charging you either way. Cash buyers just get charged silently, which is exactly why cash buyers underestimate this asset more than leveraged ones do. Now, here's the other side of the ledger, and it's the one that quietly grows. Property tax. In New Jersey or Illinois or parts of Texas, the effective rate can run past 2%. 2% of $12 million is $240,000 a year, forever, indexed to whatever the local assessor decides your house is worth. In California, the headline rate looks gentler, around 1.25%, but there's a mechanism inside it that catches almost every buyer. Under Proposition 13, a property's assessed value is frozen at the moment of purchase and can only rise about 2% a year. It resets to full market value when the property sells, which means the neighbor who bought in 1988 is paying tax on a 1988 number, and you, the day you close, reset the basis to today. Sit with that. Two identical houses on the same street, same view, same lot, same architect. One owner pays $18,000 a year. You pay $150,000 a year. Nothing about the buildings is different. The only difference is the date on the deed. You didn't just buy a house. You bought the current tax bill on a street where everyone else is still paying an old one. And then there's the thing that changed in 2017 that nobody at this price point talks about enough. The tax code stopped subsidizing you. The mortgage interest deduction is capped at the interest on $750,000 of acquisition debt. On your $7.5 million loan, that means 10% of your interest is deductible and 90% of it is not. And the deduction for state and local taxes, the line that used to make a $250,000 property tax bill survivable, is capped, and at the income required to carry this house, the phase-outs push you right back down to a $10,000 cap. So, on $240,000 of property tax, you deduct $10,000 and eat the rest. For decades, the story of the expensive house included a silent government partner who paid part of the carry. That partner left. Everybody who does the math on a mansion using the intuitions they built in the 90s gets this wrong by 6 figures a year. This is where the first trap opens, and it's the one that's gotten violent in the last few years: insurance. For most of modern history, insuring a large house was a rounding error. You called your agent, you named a number, you paid a premium that looked like a car payment. That world is gone in an entire class of desirable locations, and desirable locations are exactly where mansions are. Two things happened at once. Reinsurance, the insurance that insurance companies buy, repriced hard after a decade of wildfire, hurricane, and hail losses, and construction costs went up something like 40% in 5 years. Insurers don't insure the market value of your house. They insure the replacement cost, what it would take to rebuild that structure on that lot with those materials at today's labor rates. And on a custom house, replacement cost is often higher than what you paid. A $12 million purchase can carry an $18 million replacement figure because the market decided the neighborhood was worth 12, while the plaster crew and the stonemason and the timber framer decided the building was worth 18. So carriers started doing something they'd never done at scale. They stopped writing. In California, major insurers non-renewed policies across entire counties. Homeowners got pushed into the state's insurer of last resort, the FAIR Plan, which caps dwelling coverage at $3 million. $3 million on a house that costs $18 million to rebuild, which means you now buy a wrap, an excess and surplus lines policy stacked on top of the FAIR Plan to cover the remaining $15 million. Surplus lines carriers are not rate regulated. They charge what the risk is worth to them. Premiums of $80, $100, $150,000 a year on a single residence are no longer exotic in fire country or on the coast, and there's a clause inside that policy that quietly punishes exactly the person who buys a house like this. Most residential policies restrict coverage once a home has been vacant for 60 consecutive days. Vandalism, water damage, glass breakage, coverage narrows or disappears. Now consider who owns a mansion. Frequently someone with 3 homes, an office in another city, and a travel schedule. The house you visit 8 weeks a year is, from the underwriter's point of view, an abandoned building with a wine cellar. The fix is to have someone there. Which brings us to the part of this business that people romanticize the hardest and understand the least. You do not own staff. You employ them. The moment you hire a housekeeper who works set hours in your home, you are a household employer. You have a federal employer identification number. You withhold and remit taxes. You carry workers' compensation. Because in most states, a domestic worker who falls off a ladder in your house is a claim, and your homeowner's policy is not going to want it. You track overtime because household employees in most jurisdictions are non-exempt, and the hours over 40 pay time and a half. You handle terminations. You handle the fact that these people are in your home, around your family, with keys and codes and knowledge of when you're gone. Run a real estate at 20,000 square feet on 3 acres, and the roster is not one person. It's a housekeeper at 70,000, a second housekeeper or a part-timer for the heavy weeks, a groundskeeper or a landscape contract, which on 3 maintained acres with irrigation, hedging, seasonal color, and tree work runs 60 to 90,000 a year. A house manager or estate manager to run vendors, schedules, projects, and the other staff. That role, done competently, is 130 to 180,000. Add payroll taxes, workers' comp, and benefits, and you multiply every salary by roughly 1 1/4 to 1 1/3. Add it up conservatively, and you're at $300,000 to $400,000 a year in labor. That's not the roof. That's not the tax. That's not the insurance. That's just people. And here's the sentence that reframes the whole thing. You didn't buy a house. You founded a company. It has a payroll, an HR exposure, a vendor list, a capital expenditure schedule, and an annual budget in the 7 figures. What it does not have is revenue. Every business you've ever studied has a top line that pays for its bottom line. This one has you. Now the building itself, because buildings at this scale don't age like houses, they age like small hotels. A 20,000 square foot house has commercial grade equipment in it wearing residential clothing, multiple HVAC zones, often 6 to 12 separate systems, each with a 15-year life and a replacement cost between $15,000 and $30,000 installed. A generator large enough to carry the house, which needs a service contract and a monthly exercise cycle. An elevator, if there is one, which needs an annual inspection and a maintenance agreement running $4,000 to $8,000 a year for a machine you use to avoid a staircase. A pool of 60,000 gallons, which is chemicals and service weekly and a heater that will die, plus the pump energy that runs whether anyone swims or not. Irrigation across 3 acres. A wine room with a dedicated cooling unit that must never fail. A water feature. A gate motor. Landscape lighting on a transformer with 140 fixtures that each fail eventually. And the whole thing is tied together by an automation system, lighting, shades, audio, climate, cameras. That was state-of-the-art the year it was installed and is now a discontinued product line. Automation is where owners discover something ugly. The house has a software dependency. The processor is out of support. The programmer who wrote the original code has moved on and the file is proprietary. Replacing it is not a repair, it's a project. And the quote comes back at $80,000 to make the lights work the way they worked in 2016. And all of that equipment runs on a utility bill that behaves nothing like a house bill. Conditioning, 20,000 square feet with 12-foot ceilings and a lot of glass, is not 4 times the energy of a 5,000-foot house. It's more, because the volume of air is larger than the floor area suggests, and glass is where heat goes to leave. $1,800 to $3,000 a month in electricity through a hot summer is normal, and in a cold climate, the winter gas bill lands in the same range. Heat the pool through the shoulder seasons and add $1,000 a month for water you swim in, maybe 9 times. Then the water itself, 3 irrigated acres in a dry climate, can pull well over 1 million gallons a year. And municipalities have moved to tiered rates specifically designed to punish the top of that curve. Owners open a summer water bill for $4,000 and assume there's a leak. There isn't. That's the lawn. Call it $45,000 to $70,000 a year in energy and water, and understand that most of it is spent conditioning rooms nobody entered that day. Budget the maintenance properly, and it's 1 to 1.5% of replacement cost annually. On an $18 million replacement figure, that's $180,000 to $270,000 a year, averaged. Some years it's $40,000. Then there's a year it's $600,000 because the slate roof needs its copper flashing redone and the stucco has to come off one elevation and the mechanical room gets rebuilt. And you will pay above market for every hour of that work for a reason that has nothing to do with anyone taking advantage of you. It's a supply problem. The trades that can work on this house, the plasterer who does hand-troweled finishes, the mason who can match a 100-year-old stone, the millwork shop that can replicate the paneling, the roofer who's actually touched slate, are a handful of firms in any given metro. They're booked. There is no comparison shopping because there is nothing to compare. On an ordinary house, 3 bids create a price. On this house, 1 bid is the price. So far, the mansion sounds like a very expensive hobby with a lawn. Here's where it turns into something structurally worse. You have to sell it eventually. Everyone does, and this is the number that decides whether the last decade was expensive or catastrophic. How many people can buy your house? At $400,000, the buyer pool in a mid-size American metro is tens of thousands of households. At $2 million, it's a few thousand. At $12 million, in most metros in this country, the number of households that can write that check and want that specific house in that specific location in a given year is somewhere between 4 and 40. Not 4,000. 4. It is a number small enough to count. That single fact drives everything about the exit. With that few buyers, there is no price discovery. There is no comparable sale because the last house like yours sold 3 years ago in different conditions. The appraiser has nothing to work with, which makes financing harder for your buyer, which shrinks your pool again. Days on market at this level routinely runs 200, 400, 600 days. And every one of those days, you're paying the full carry on a house you've already emotionally left. Then there's the discount. Trophy properties are listed at aspirational numbers, and the gap between ask and clearing price at the top of the market is not 5%. Chartwell in Bel Air was listed at $350 million and sold for $150. Copper Beach Farm in Greenwich listed at $190 million and traded at $120. These are the famous ones, but the pattern holds much further down. 15 to 30% off ask is an ordinary outcome for a large custom house, and the reason is simple arithmetic. With 4 buyers, whoever shows up sets the price, and there is no second bidder to argue with them. And here's the part that catches people who spent the most. The more the house is yours, the less it's worth. Every dollar you put into personalization narrows your buyer pool. The two-lane bowling alley cost $400,000 and appraises at nothing, worse than nothing, because the next buyer prices in what it costs to rip out. The recording studio, the indoor sport court, the 20-seat theater with the fixed seating, the safe room, the koi pond, the 12,000-bottle cellar in a market where nobody collects wine anymore. Appraisers have a term for this: functional obsolescence, money spent on a feature that the market does not want back. And the same logic applies to the house as a whole. Real estate has a ceiling per neighborhood, and you cannot build past it. If the best street in your area supports $800 a square foot, and you build a 20,000-foot house at $950 a foot in construction cost alone, you have manufactured a $19 million building on a $16 million street. The market doesn't reimburse construction. It prices location and then grudgingly pays for size. The most expensive demonstration of this principle in modern history sat in Bel Air. A developer built a 105,000 square foot house and listed it at $500 million. It went into receivership before it ever sold, and in 2022, it went to auction and cleared at $126 million. Not because the construction was bad, because there was no one on earth who wanted that exact building at that price on that day. And when you're selling to a pool of zero, the number goes wherever it has to go. Now stack the exit costs on top of a discounted price. Broker commissions at 4 to 5%. In New York, a mansion tax that scales from 1% above $1 million to 3.9% above $25 million. In Los Angeles, a transfer tax passed in 2022 that takes 4% of the gross sale price above roughly $5 million and 5.5% above roughly $10 million, paid by the seller, calculated on the entire price, not the gain. Sell a $12 million house in Los Angeles and roughly $660,000 leaves before anything else is settled. Not on your profit, on the price. If you lost money on the house, you still pay it. That tax did something its authors didn't fully price in. It removed the exit. High-end sales volume in the affected bracket fell sharply because sellers who didn't have to move simply stopped moving. Liquidity in this asset was already thin. A transfer tax made staying cheaper than leaving, and a market where nobody will sell is also a market where nobody can. Now, the question that hangs over all of it: how does a mansion actually die? Not in a foreclosure, not usually. It dies from arithmetic that outlives its owner. Edward Stotesbury, one of the wealthiest financiers in America, built White Marsh Hall outside Philadelphia, 147 rooms, gardens designed by a landscape architect of national reputation, a house that people at the time compared to a European palace. Stotesbury died in 1938, and here's the thing: nobody wanted it. Not because it wasn't beautiful, because the operating cost of the building had no relationship to any use anyone could put it to. It was offered around, it sat, it was used for wartime art storage, then for corporate research, then for nothing. It was demolished in 1980. A few miles away, Peter Widener built Linwood Hall, 110 rooms of Gilded Age ambition. It spent most of the last 70 years slowly rotting, roof failing, sold and resold, at prices that would embarrass a suburban split level, because everyone who looked at it did the same math and arrived at the same answer. Go to Fifth Avenue in Manhattan and look for the Vanderbilt houses. They were the most conspicuous private structures in the country. Every one of them is gone. The Cornelius Vanderbilt II house at 57th Street, the largest private residence ever built in New York City, was demolished in 1927. While the family still had money, the land underneath was simply worth more without the house on it, and the house cost too much to keep for anyone to argue. That's the real death of a mansion. Not bankruptcy, obsolescence. The building becomes a liability attached to an asset, and one day, someone runs the numbers and realizes the lot is the asset and the house is the cost of getting to it. Every teardown in every expensive suburb in America is a smaller version of the same event. The two Gilded Age houses everyone can still visit tell you what the survivors did differently. The Breakers in Newport survives because the family effectively handed it to a preservation society. Biltmore in North Carolina survives because in 1930 the family opened it to the public, and today it operates as a business, a hotel, a winery, a farm, well over 1 million ticketed visitors a year. Biltmore didn't survive as a house. It survived by becoming an enterprise with revenue, which is the only thing that ever pays for a building of that size. So, where does the money in this asset actually get made? Because it does get made. Just not by the person living there. It's made by the developer who assembles the lot, secures the entitlement, builds the spec house, and exits inside 24 months, collecting the difference between construction cost and trophy price without ever paying a full year of carry. It's made by the land itself in the handful of locations where supply is genuinely fixed and the ultra-wealthy keep arriving. And it's made by the professionals in orbit around the transaction. The brokers on a 5% commission, the architect on a percentage of construction, the estate manager, the firms that do the flashing and the plaster and the automation. The owner's return, meanwhile, is one number: appreciation minus carry. And the carry is 4% a year, compounding against you. In a market that appreciates 6%, you're netting 2, and only if nothing breaks. In a flat market, you're bleeding 4% of a large number every year. Add the opportunity cost of the equity and the exit costs and the discount to ask, and the honest description of most mansions over a full ownership cycle is not an investment. It's a consumption item with a resale value, the most expensive consumption item most people will ever buy, and the only one that comes with employees, which is fine. That's allowed, but it needs to be entered with open eyes because the failure mode is specific and predictable. Someone buys at the top of what they can afford, discovers that ownership costs another $1 million a year they didn't model, starts deferring maintenance, watches the house slide from immaculate to merely nice, and then has to sell into a for-buyer market as a property that now shows deferred maintenance. That's the sequence. It almost never starts with a market crash. It starts with a budget that accounted for the purchase and not the operation. And the ones who do it well look at it completely differently. They buy well under their capacity, not at the edge of it. They treat the annual burn as a subscription they've consciously agreed to pay for the way it lets them live. They resist the personalization that feels like the whole point because they know the bowling alley is a donation. They buy in the few locations with genuinely constrained supply where the land does the heavy lifting, and they never once tell themselves the house is an investment, because the moment you call it an investment, you start making decisions the asset will punish. So if you buy the mansion, understand exactly what changed hands. You are not buying a house. You are buying a payroll, an insurance negotiation you will have every year for the rest of your life, a mechanical plant that needs a 20-year capital plan, and an exit that depends on 4 strangers wanting precisely what you wanted on the specific month you need to leave. The silence in that front hall on a Tuesday morning is real. It's just not free. And it was never the thing you were actually paying for. You were paying for everything standing behind it. And that bill arrives every month, forever, whether you're home or not.